All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today's May 22nd, 2024. And we interrupt this endless stream of bloviation about just how wonderful and amazing Nvidia's earnings are guaranteed to be to bring you other things happening in the world. That's right. Today, everybody just wants to talk about Nvidia earnings. And then tomorrow, everybody's going to want to talk about Nvidia earnings. But for now, let's talk about the other stories happening. Target just came out with an earnings report, and it was another lousy report from Target. Their fourth consecutive drop in sales. We had comparable store sales at Target, or same-store sales, down 3.7%. That is a year straight that the comps at Target have been getting crushed. This company just can't catch a break here. Also, they forecast flat to 2% growth in same-store sales, a little bit below expectations. Adjusted earnings per share were down 1% year over year. Revenue was down 3.1% year over year. Their guidance was on the light side. The midpoint came in just a little bit below what the market was expecting, and Target stock is getting clobbered. The last I looked, it was down about 9% ahead of the opening bell. And it looks like it's that guidance that really torpedoed Target. Nobody was really expecting a good quarter from Target, but their guidance came in forecasting that low to no same-store sales growth for this quarter. And again, we're coming up against some pretty weak comps now, right? The whole, like, the comps last year were so strong, and that's why our numbers are down. That argument doesn't hold up anymore because we're talking about lousy quarters a year ago that we're comparing to. So if we're seeing additional growth here, if we're seeing additional shrinkage here, that's shrinkage from an already shrunk number. We're starting to compound. Now, Target's getting really clobbered by the fact that discretionary spending is way down. Something we've been talking about on this channel for the better part of, two and a half years, pretty much since the channel was born, about how consumers are spending more money on their needs and there's much less left over for their wants at the end of the day. Those who are lucky enough to have any money left for their wants, they're spending that money typically on services or on experiences, not on stuff. People overloaded on stuff when they were locked inside their house during the pandemic. So now they're a little more shifting towards travel and things like that, those who still have money left. And of course, Target is just perfectly positioned to get destroyed by this trend because Target, unlike their main competitor Walmart, did not make a successful pivot to groceries a few years ago. Target stayed with the apparel and with the merchandise, right? When you walk into a Target store, you're surrounded by apparel. Usually clothes is the first thing you're going to see versus a Walmart. As soon as you walk in, you're in the grocery section. To Target, to get to the grocery at Target, you pretty much have to walk all the way to the back of the store. You're almost in the automotive section when you get to the food at Target. So that has really clobbered that company. Discretionary spending continues to get clobbered. It's probably going to continue getting clobbered for the foreseeable future. And that's despite the fact that buy now, pay later has given consumers an adrenaline shot in this last year or so, this new way to take out debt and try to juice retail numbers higher. And well, it worked a little bit last year. We had pretty good numbers in the fourth quarter, but now it's starting to pile up. And well, it's not going to be enough for much longer. And speaking of buy now, pay later, we had news this morning that the CFPB, or the Consumer Financial Protection Bureau, is out with a new rule, or should I say they published a revised interpretation of existing laws and regulations. In other words, we're just changing the law because we're not actually changing the wording of the law. We're just letting you know that according to us, now the wording of the law means something different. That's what happens when a new interpretation of existing law comes out from one of these regulatory bodies. And they are going after buy now, pay later. They're saying things like disputes, things like refunds, things like returns, billing statements, fee structures, and communication of fee structures, that all of those things need to be handled in the same way that credit cards are handled according to existing law. They're basically saying BNPL is no different than a credit card when it comes to these things. But noticeably absent from the list of things that the CFPB is going to crack down on with this buy now, pay later debt is reporting to the credit bureaus. That was not included in any of the articles I read this morning about changes to the interpretation of the rules governing BNPL. So still buy now, pay later is going to be happening in a vacuum. We're not going to know how much borrowing is really going on. People who don't pay it back are not going to have their names put on the naughty list over at Experian and Equifax and all the credit unions. And so I don't think this is necessarily going to cause a big shift in the way buy now, pay later is handled or the way people are recklessly piling into buy now, pay later debt. But this may be a precursor to that. This might be like the first shot across the bow. That big one is reporting to the credit agencies. If and when the CFPB says, BNPL, you need to start reporting this data, that's when we find out, are these fintech firms really full of it or not? Have they been telling us the truth about this low amount of defaults? And, oh, don't worry, most people pay us back, because we've had 2 independent reports in the last few days that suggest defaults and delinquencies in the buy now, pay later space are in high double-digit percentages, not the rosy picture that these fintechs are telling us. Also, of course, the main story this morning is going to be, or this afternoon, I should say, is going to be Nvidia earnings. The AI darling reports after the bell this morning. And the press, look, go to any mainstream financial website and they're hyperventilating already about how awesome these earnings are sure to be. And look, guys, all the big tech companies that just reported, right? Meta, Amazon, Microsoft, Tesla, Apple, they all had one thing in common. They all reported big plans to make big investments in capital and AI hardware. So all of these big tech companies that sit on mountains of cash have all said, look, we plan to keep buying up GPUs. So according to everything that we've seen so far, it's probably going to be another amazing quarter. And that $7.5 billion credit line to CoreWeave that came out last week, I don't know if that's going to be included in this quarter. It's possible it is. CoreWeave could have placed the order already and then gone and gotten the debt financing to cover it after the fact, which would mean, according to accounting practices, that order placed means revenue booked, not when it's paid. That's, what is it, accrual accounting or cash accounting? I'm not an accountant. But it's possible that $7.5 billion to CoreWeave was included in this quarter, or it could be included in the next quarter's forward guidance. So look, NVIDIA is probably going to report amazing numbers. Once again, they're saying their revenue is going to triple. And the question is, though, is awesome earnings enough? Is near perfect going to be enough? Everybody and their brother is super bullish on this company. All right. Every fund manager on Wall Street is afraid to not own this stock because they don't want to be the only one who doesn't own it. Every analyst is afraid to not have a bullish rating on the stock because nobody wants to be the only one who's bearish. That's called groupthink, and that's very dangerous. Now, I'm not saying NVIDIA's earnings are going to crash the stock market this afternoon, although that's possible, but all of the ingredients are there. All right. It's like that Smokey the Bear sign in the woods. It's dry. It's sunny. It hasn't rained in a month. Conditions for a forest fire are near perfect. That doesn't mean there's going to be a forest fire today because you have to have that spark. Now, what would that spark be? That spark that starts a forest fire? NVIDIA's forward guidance. That is what's going to make or break pretty much this whole market bubble this afternoon. It's not so much on what NVIDIA posts, right? NVIDIA is going to post their big numbers. It's going to be amazing. And me, Kevin's going to giggle like a Beatle fan, right? That's going to happen this afternoon. But then the guidance comes out. And that's the big question. What will that forward guidance be? Are they going to continue to guide for this massive growth? If so, the stock will rally big time. Tom Lee from Fundstrat is out saying 20% this morning. If that guidance comes in, even the tiniest little bit light, if that guidance is anything but perfect, this stock will get crushed. That's what's going to make or break this company. Now, speaking of that forward guidance, there was a couple of stories in the last few days that might play a role in that. We've got an AI price war just broke out in China that's seen companies like ByteDance, Baidu, and Alibaba have lowered the prices of their large language models by numbers like 97%. 99%. Baidu made theirs free, a 100% discount. So it's going to be pretty hard to continue building out these massive AI data centers if the companies that are paying to rent those data centers are not making any money for their product. That was the whole gist of the stream that I made on Friday afternoon, just how, like, look, guys, there's very little actual organic revenue at the very far end of the supply chain here. The end users are not making money yet. So that's in China. China can't get their hands on Nvidia's top of the line chips, so it's not going to translate necessarily into anything here in the States. But if something like that were to break out here in the US, you bet that's going to cause a massive revaluation in the market. Also, last night, there was a story about Amazon possibly canceling orders for GPUs in the Financial Times. It turns out that story was a little bit misleading. There's an update out this morning that says, no, they didn't cancel anything. They're just delaying that order for this one project, this SIBA supercomputer that Amazon is building. And they're building it with NVIDIA, and they want to use their new Blackwell chips. That's their next generation GPU that's coming out. And so they're going to wait to place that order. It's not an order that's already been placed. And so there was no cancellation of orders. There was no delay of an orders. They're just going to wait for an order they haven't placed yet. Well, if they're not placing that order yet, it's possible that could affect that forward guidance because the Blackwell chips don't come out until the fourth quarter of this year. So that's one to keep an eye on. It's not a death sentence. It's not a doom story or anything like that about NVIDIA, but it is one that makes you, maybe we want to think twice about that forward guidance. Also, Japan, we've got the 10-year Japanese government bond crossed 1%, a massive threshold, an entire 1% interest for locking your money up for 10 years in Japan. It's the highest number in 11 years, the highest number since 2013. 1% is the highest it's been in 11 years. What is going on in Japan? Guys, if that interest rate gap between the U.S. and Japan doesn't close, the Japanese yen is going to continue to collapse. And, well, basically, yen bears are forcing the Bank of Japan to start raising interest rates. And when your debt to GDP is over 260%, that's not so good for your government. So keep an eye on what's happening in Japan. They're going to make a mess in the world's third largest economy. And with that, why don't we shrink my big melon of a head and let's get into this market this morning, shall we? Guys, don't forget that like button for the algorithm. It really helps get this message out. And if you're new here, hit subscribe and that notification bell right next to it and have your coffee with the melon heads every morning as we go through markets. The S&P 500 right now is down 8 points or 0.15%, barely budging. Again, not a whole lot's going to happen until that NVIDIA report comes out. Everybody's waiting on that one this morning. The Dow is down 74 points or about 0.2%, not faring quite as well as the S&P this morning. And the NASDAQ is virtually unchanged here, up 0.2% or 0.00%, barely budging on the NASDAQ. The DXY, meanwhile, is a little bit higher this morning, 15 basis points. The dollar is at 104.81 as measured against a basket of other global currencies. And interest rates looks like they're moving higher this morning. We got the 30-year treasuries at 4.58. That's up 2.5 basis points. The 10 years at 4.453, up almost 4 basis points. The 2 years at 4.867, up 3.5 points. And the 1 month is at 5.371. Now, looking at commodities, it looks like this monster bull run in commodities is taking a breather this morning. We've got June gold futures at $24.13. That's down about $12.65 or 0.5% lower. Spot gold is at $24.09, down $11. July silver futures at $31.99. That's down about 9 cents or 0.25%. Spot silver's at $31.76, down 22 cents or 0.7%. We've got copper at $4.91 for July futures. That's down 3.7% this morning. So that copper squeeze losing a little bit of momentum here. Possible that's having a drag on gold and silver also. Platinum, meanwhile, is down 0.25%. Palladium is down 2.4%. And West Texas Intermediate crude oil for the month of July is at $78.04. That's down 62 cents or about 0.8% lower. Let's take a look at that silver chart here. Again, a little bit of a red here. Nothing too worrying here. Looks like this chart stalled out around 32.50. Currently at 31.73 for spot silver. Just want to send a shout out to Bai Xiaojun at the Oriental Ghost on X, who posted this one this morning showing the Shanghai price of silver at the market close was $35.69. So the arbitrage between U.S. and Shanghai gold, silver prices continues to grow. It's now almost $4. So more tension between the two prices. That means more upward pressure on Western silver prices, more flow of metal from London and New York over to Shanghai as long as that big price arbitrage exists. Looking over at the Bitcoin market, we've got Bitcoin is back below 70,000 this morning, down about $300, trading at $69,815 on Coinbase. Now, again, we had that big run up earlier this week with the Bitcoin ETFs with the Bitcoin price, and it looks like that was driven primarily by ETFs. I got this one from Zero Hedge this morning. Let's close out my messages here. Huge inflows into IBIT yesterday at $290 million. It was the biggest one-day inflow since April 5th, and this was purely on ETH news. And that ETH news, by the way, they're talking about is the rumors that the SEC is close to approving an Ethereum spot ETF. And I guess people are piling into Ethereum. And then the big move up in Ethereum is having a little bit of a drag upward on Bitcoin price. So a spot Ethereum ETF causing a little bit of FOMO buying in Bitcoin here. $290 million flowed into the BlackRock Bitcoin ETF yesterday. That is a big one there. $290 million bucks. So Bitcoin's looking all right this morning. Now here's the big one. Target misses earnings estimates as discretionary demand is still under pressure and the stock tumbles. This is 4 quarters in a row for Target here. Target's fiscal first quarter earnings miss Wall Street estimates as soft demand for discretionary goods continues to weigh on the retailer's revenue growth. The company's adjusted earnings of $2.03 a share missed analyst estimates for $2.06 according to FactSet, and were 1% below last year's 205. Revenue fell by 3.1% year over year to $24.5 billion. That's roughly in line with consensus estimates. Same-store sales fell by 3.7% from the year-ago quarter, which also matched expectations. Again, same-store sales are not adjusted for inflation, so you can subtract another 3.5% from that. So you're looking at over 7% decline in real sales at Target. That perfectly illustrates just how hurting the middle-class consumer is. This is Target's 4th consecutive quarter of negative same-store sales growth. Sales declines largely have been driven by weak demand for non-essentials, such as apparel and home decor, Target executives said, echoing comments made by other big-box retailers. Yet because Target's discretionary categories have long outshined its non-essentials, the pullback has been especially painful. Over the past 2 years, Target has been losing market share to competitors that have strong grocery business and focus on values such as Walmart or Costco. The company has launched several initiatives in a bid to lure those shoppers back, including rolling out revamped loyalty program, introducing a new low-cost private label, and cutting prices on thousands of household mainstays. That's a story that broke just earlier this week. Target announced that they're cutting prices on 5,000 items this year. So a little bit of deflation possibly going on with consumer prices here, with Target lowering 5,000 prices, a little bit of a price war maybe between them and Costco and Walmart. Target stock, though, this morning getting crushed, down 9.25%, trading at $141.40. That's down $14.30. Rough morning for Target shareholders. And speaking of retail and consumers, buy now, pay later needs credit card-like oversight, the CFPB says. The regulator clarifies which rules apply to the installment loans, and the director wants to prevent sidestepping of regulations. Buy now, pay later lenders such as Block, Affirm, and Klarna should be treated in the same ways like credit card providers, according to one U.S. financial regulator. The Consumer Financial Protection Bureau published a new interpretation of existing laws and regulations on Wednesday to make clear that, like credit card providers, BNPL firms must investigate disputes, refund returned products or voided services, and provide billing statements. So the CFPB, they didn't change the law. They're just saying, we read the law again, and we think it means something new now because of buy now, pay later. But the key factors here: investigate disputes, refund return products or voided services, and provide billing statement. There was also some language about fees. Noticeably absent from this story is anything about reporting delinquencies to the credit bureaus. The buy now, pay later companies still don't have to report delinquencies. So we still don't know how much of this debt is not getting paid back, is going delinquent. And remember, guys, a lot of these companies are securitizing this debt. They're rubber stamping it AAA. The ratings agencies are calling this AAA because of unverifiable statements by company CEOs that say, don't worry, these folks are all paying us back. It's great. It's wonderful. You're going to love it. And they're selling this stuff into income ETFs. I did a video about this a couple of months ago, but there's no way to verify that information because they don't have to report the data to the consumer, to the credit agencies. And how would they even report this data to the credit agencies When you're shopping at Walmart and it asks if you want to buy now, pay later, does it ask you for your social security number? How do they even track you? How do they even know who's making the payments or not? And how would they report that data? This debt is garbage, guys. And with the trend of doom spending of people that are out there just running up credit cards and running up debt with no intention of ever paying it back, this is not going to end well, guys. This is going to go down in history as a fiasco. But this means that buy now, pay later companies should be treated more like those that offer credit cards, but not entirely. The CFPB didn't interpret the existing framework to say that buy now, pay later firms have to assess whether a consumer has the ability to repay their short-term installment loans. And that's just wonderful. The CFPB, the Consumer Financial Protection Board, is saying, don't worry, buy now, pay later, guys. You don't even have to wonder if these people can pay you back. Just go ahead and make the loan. What's the worst thing that could happen? Gotta love this story. That is our financial regulators in all their glory. Meanwhile, let's shift gears over to Japan here. Japan's benchmark bond yield rises above 1% for the first time in 11 years. Big threshold, big things happening in Japan. 1% interest. If you lock up your money for 10 years, try not to spend it all in one place. The yield on Japan's 10-year government bond on Wednesday rose 1.6 basis points to 1.01%. Reaching 1% for the first time since May of 2013, which was around the time the Bank of Japan was embarking on its ultra-loose policy campaign. The move higher in yields comes as investors continue to build bets that the BOJ will be forced to raise rates from their current 0.1% amid signs that inflationary pressures may be building. Finance Minister, somebody I can't pronounce, said on Tuesday that he was worried that weakness in the yen, which is trading near a 34-year low versus the U.S. dollar, will push up import prices and make it harder for Japanese workers to achieve real wages. So remember, Japan imports almost everything. They're a very resource-poor country. They import almost all their food and almost all their energy. So if their currency is collapsing, remember, when you buy these commodities on the world market, you need dollars to do it. So Japan would have to sell their yen to buy dollars to buy food and energy. If the yen is collapsing, that means they need to sell even more yen to buy those dollars, and it makes their import prices go higher. So the Japanese consumers are very vulnerable to inflation here, even though inflation has been noticeably absent for quite a while in Japan. Yields were also pressured higher by disappointing demand for an auction for 40-year bonds, which pushed their yield up above 2.52%. The most since the maturity was issued in 2015, according to Reuters. You got to love it, guys. The yield on a 40-year Japanese government bond is just 2.5%. What is that? Not even half of what you can get for a 1-month treasury here in the States. So think about that, guys. You can borrow money for 40 years in Japan, paying 2.5% interest, turn around and lend that money to the U.S. government for a month and make 5% interest or 5.4% interest. That is the yen carry trade, and that is why the Japanese yen is collapsing. That massive gap between interest rates in the States and Japan, or the interest rates between Japan and Europe, you can borrow yen, sell those yen for dollars or euros, and then go buy dollar or euro assets and make a much bigger interest rate than you're paying on that Japanese debt. And so there is this natural flow of money out of Japan into the other Western economies to harvest that difference, that arbitrage between the interest rates. Until that gap closes, the yen is going to keep collapsing. And take a look at this chart of the Japanese yen. You can kind of see it going back to the start of the year. This chart has been moving higher. Remember, as this chart moves higher, this is USD JPY. This is the yen falling versus the dollar. And so it takes more and more yen to make $1. Now, we hit a high of about 160 a few weeks ago. That's when the Japanese finance ministry intervened and they dumped U.S. dollars to try to prop up their currency. It had a very delayed effect here. Let me bring up my marker. It did bring us down from about 160 all the way down to about 151. Now, we caught a bounce and we started moving higher right away. Then CPI last week came out. CPI was a little lower than expected, so the dollar crashed a little bit on that. The yen strengthened. The chart moved lower, but once again, this chart is moving higher. The yen continuing to grind higher still, currently at 156.5 yen to make $1 and moving to the upside. So keep an eye on that yen carry trade. All right, now the topic that's on everybody's mind, Nvidia. All right, the AI darling. The stock's trading at $957.50 right now. Pretty much at its all-time high. It never quite got to that $1,000 threshold. It's up about 1/3% ahead of the opening bell today. But let's talk about it. There's so much commentary on Nvidia's earnings right now. Everybody is universally bullish on this stock. And hey, maybe there's good reason for that. The numbers Nvidia's been reporting have been incredible. But you know, when everybody is bullish on the same thing, that's usually a very bad omen, right? When everybody is so sure something is going to happen, that's right about the time something else happens. I'm not saying that's definitely going to happen today, but when everyone and their brother's bullish, you better take notice. So let's talk the bullish side first. A tidal wave of cash is headed for markets post NVIDIA results, this strategist argues. This is in Market Watch just this morning here. Critical information for the U.S. trading day. With one eye open for Fed minutes and any insights into rate cut plans, investors may hit the snooze button until NVIDIA reports after Wednesday's close. The bar has been set high for the heavy hitter, which alongside the S&P 500 and the NASDAQ recorded a fresh record close on Tuesday. And there's more where that comes from, says our call of the day from Fundstrat's co-founder and head of research, Tom Lee, who sees a wall of pent-up investor cash flooding markets following NVIDIA's results. There's a lot of money sitting in money markets still. A lot of people have been raising cash. And Tom Lee says once those NVIDIA results come out, that cash could come in. And I guess he's suggesting it's going to be flowing into NVIDIA. I think there's a lot of hesitation out there, but in our view, markets are going to rally post NVIDIA results. And so I'd recommend being overweight stock into NVIDIA's reports, he told clients in an update. He notes investors have positioned themselves extremely cautiously. Really, everything is at an all-time high. How can you say investors are positioned extremely cautiously? I don't understand that, but I'll take his word from it. Tom Lee's a smart guy. That's ahead of the tech behemoth's results, citing data that shows over the last 3 weeks, cash balances have been rising for both institutional and retail investors. Cash balances rose $16 billion just in the past week, a significant amount of liquidity on the sidelines, Lee says. Anecdotally, in our recent conversation with institutional investors, we get the sense the investors have been cautious ahead of NVIDIA's results because of the size of the importance of this company to the broader technology thesis, i.e. the AI mania. His post-NVIDIA rally prediction is backed by some stats on the typical market reaction to these last 8 results. The average is 20% plus in the last 2 years, so we think the probabilities favor a big move post Wednesday's results. So calling for a 20% move essentially to the upside here because this is a very bullish call. So, I mean, that would place NVIDIA's market cap somewhere around what? $2.75 trillion. I mean, we're talking about a $1,200 stock price if we get close to a 20% move here or something close to a $1,200 price. That's a very bullish call here from Tom Lee over at Fundstrat. Now let's take the other side. There's some other stories going on that are worth noticing here. Alibaba sparks a China AI price war with a spate of steep discounts. Now, this one doesn't affect NVIDIA because this is China, and Chinese firms can't buy NVIDIA's top-of-the-line GPUs, and China's firms don't like NVIDIA's toned-down GPUs. So this one won't necessarily translate into NVIDIA's earnings, but this is something that AI investors need to be aware of. Alibaba, yeah, don't grab that, Ali. Alibaba Group Holdings slashed prices for a clutch of artificial intelligence services by as much as 97%, spurring an immediate response from Baidu and potentially the start of a price war in China's nascent AI market. And what do you mean potentially start of a price war? When prices go down by 97%, you're essentially making that thing free. There is no potentially price war about this. This is a full-blown hot price war in Chinese AI. Baidu Cloud said it would offer free services based on its Ernie AI models on Tuesday, hours after Alibaba offered deals on 9 products built atop its own Tongyi Qianwen. ByteDance last week announced pricing for AI services that it said were 99% lower than Chinese industry norms, using Ernie and Alibaba's Quen as benchmarks. So look at these numbers here, guys. You've got Alibaba dropping by 97%, ByteDance dropping by 99%. Baidu says, hold my beer, drops their price 100% and makes it free. 97, 99, 100% price discounts for these large language models in China. The tit-for-tat maneuvers mark the opening salvos of a price-based battle with AI. What do you mean opening salvos? Once the product is free, what's left to do? Are you going to pay people to use your product? Is the pricing going to go negative? kind of leaves you nowhere to go when you cut prices 100%. This is a field that's attracting billions of dollars of investment from startups and internet leaders, including Tencent Holdings. The flurry of investment has created scores of AI models and spawned many more consumer and enterprise products in turn, all fighting for the critical mass of users needed to speed AI development. And now, look, maybe there's some other angle here. Maybe they're trying to attract more users to their greater ecosystem so they can capture earnings elsewhere in some other services or products, or maybe they're trying to sell ads. This could be like in early Facebook days, right, where you are the product and that's how they make their money and offering it to you for free. But that being said, if they don't figure out a way to make money off of this thing, if they're essentially making them free 97, 99, 100% discounts, then how in the world are they going to continue to build out all of these massive AI data centers that come with incredibly large capital price tags for all of these GPUs? Even if they're not NVIDIA GPUs, whatever tech China's using, it's probably not cheap. Well, if the product, the end user, is free, how are they paying for this stuff? It's a question people need to start asking. How are they paying for it? And that's what I've been saying all along. It's all investor cash. It's all retail FOMOing into stocks. That's what's paying for AI right now. There are very few people actually paying cash for an AI product right now, even though they're putting the words or the initials AI on freaking toothbrushes now. I don't know how an AI toothbrush works. But at the end of the day, if they don't make money, this thing goes down in flames. And, well, here you go, 97, 99, 100% price cuts. Now, we had another story going on about Amazon. There was a story in the Financial Times yesterday that said Amazon was canceling orders for GPUs because they wanted to wait for these next generation ones. It was getting a lot of attention on X last night. Now, they're out this morning with a clarification on this one. Amazon says it has not halted any NVIDIA chip orders. So I wanted to talk to this one. Amazon Cloud Services Unit said on Tuesday that it has not halted any orders of NVIDIA's most advanced chips on the market, but has instead decided to purchase the company's newer state-of-the-art chip for an upcoming supercomputer project between the companies. Earlier, the Financial Times had reported that Amazon Web Services, the world's largest cloud services firm, had fully transitioned its previous orders for NVIDIA's Grace Hopper chips, that's like the H100, to its newer Blackwell graphics processing unit that NVIDIA announced in March. An AWS spokesman told Reuters that the transition from Grace Hopper chips to Blackwell chips applies only to Project Seba, a supercomputer that AWS and NVIDIA are building together. AWS continues to offer other services based on NVIDIA's Hopper chips, its flagship model for training AI large language models, the spokesman said. The project transition was announced by the two firms in March when NVIDIA unveiled the new Blackwell chips. So this story, a lot of people were like, oh my God, NVIDIA is canceling orders. This is going to kill NVIDIA's forward guidance. So they didn't cancel any orders. That's the first thing. Now, what they announced is that this one project, this Seba supercomputer, is going to use the Blackwell chips and not the H100 chips. All right. So here's the thing about that. The Blackwell chip is expected to be released in the fourth quarter of this year. And this Project Seba was supposed to have 20,000 GPUs in it. Now, if this 20,000 GPUs aren't going to get ordered until the fourth quarter, and they're saying that the price tag of this Blackwell chip could be somewhere around $50,000 each, you're talking $1 billion worth of GPU orders that Amazon hasn't placed yet, but they're saying they're going to place these orders for the Blackwell chips. That means there's $1 billion of demand that is probably not going to show up in forward guidance for this quarter. It won't show up in forward guidance until the fourth quarter. So this is one story. Again, I think that the market people maybe made a bigger deal out of this than they should have last night. But this does suggest a little bit of a weakness in forward guidance this afternoon. If other companies follow Amazon's lead and they decide they want to wait for the better chip in the fourth quarter, that means we could be looking at some weak guidance for the second and the third. Just something, well, I guess it would be for the third because we're in the second now. So it's just something to think about. It could potentially mean a change to the forward guidance for NVIDIA. Again, people were making a bigger deal out of this story than it needed to last night. And lastly, we've got Amazon plans to give Alexa an AI overhaul and a monthly subscription price. Looks like they're going to be charging for something that they currently give away for free. The Seattle-based tech and retail giant will launch a more conversational version of Alexa later this year, potentially positioning it to better compete with the new generative AI-powered chatbots from companies including Google and OpenAI, according to two sources familiar with the matter who asked not to be named because the discussions were private. Amazon's subscription for Alexa will not be included in the $139 per year Prime offering, and Amazon has not yet nailed down the price point, one source said. So they're going to make her better, and they're going to charge more. This is clearly an answer to what OpenAI announced last week with their stolen Scarlett Johansson voice. Now Amazon's getting in with Alexa. By the way, how many of the melon heads out there have Alexa devices near their TV? Alexa, what is the airspeed velocity of an unladen swallow? You're welcome. Anybody who's got that device chirping in their ears right now. And I just want to say thank you very much to the inflation situation. Thank you, TIS, for the super chat, sir. He says utilities outperform indexes in late stages of a bull market. XLU have blown away the S&P in the last 2 months. Big money is getting defensive. Now, I have seen the inflation situation, and Michael Gayed, the at Lead Lag Report, has been talking a lot about this one on his channel. Now, the narrative that's being used, maybe it's a cover story, maybe it's accurate, but the narrative is that utilities are rallying because AI data centers are going to need so much energy that power prices are going to be driven higher. And because power prices are going to be driven higher, the utility stocks are going to do well. These GPUs use a ton of power. And so if they're building out tens of thousands of these GPUs, they're going to be draining power. The utilities are going to have no choice but to work with them. And I can tell you a lot of utility companies are cutting deals for power for these big data centers. Now, here's the thing here. I don't think the market has really thought this out, all right? Because first of all, the power grid just can't handle it. If we really do build out AI the way they're talking about, we're going to be building out, like this is going to turn into a quadrillion-dollar industry, like people are saying, the power grid just cannot handle that. And I don't know if you guys have ever seen what it takes to get a power plant built in this country when these idiots with the pink hair are in charge of energy policy. And every time you try to build a power plant, they freaking super glue themselves to the Mona Lisa or throw tomato soup at a freaking Van Gogh or whatever the heck it is they do, or block traffic or smash gas pumps. You really think there's going to be this massive power grid build out with those a-holes in charge of energy policy? That's a massive dent in this AI narrative. And that means since we're not going to be able to build out all these power plants, probably power prices are going to go sharply higher. Well, if energy prices start going sharply higher because of all the demand for data centers, that's going to translate into higher consumer prices because everything has an energy footprint. And so if AI companies start driving up power prices, it's going to drive up consumer prices. And the whole premise of this market rally, besides AI mania, is that the Fed is going to start cutting interest rates any day now to fight inflation. Well, that's hard to do when power prices are surging. So pay attention to that rally in utilities. Traditionally, when the utilities outperform, that means investors are getting defensive. That means something bad this way cometh. But they're trying to spin it as saying, no, utilities outperforming means AI is going to be so great. It's up to you which side of the story you want to believe. TIS, that was an excellent comment. Thank you, sir, for pointing that one out. It's something I've been meaning to talk about on this channel for a while, but I am remiss. I haven't talked about it. So thank you, sir, for the super chat and the support of the channel. And thank you to all my channel members, melonheads and magnanimous melonheads alike, for supporting the channel. I got links down below to all that good stuff. Looking forward to talking to you magnanimous melonheads on our weekly Zoom get-together at 1 p.m. Eastern time this afternoon. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody else, until next time, live small and dream big.